Do you want to lower your taxes? There is opportunity, but most people don't realize it or utilize it. The secret is in looking forward, not looking back at last year. Here to discuss is Tim Stearns, CFP, Chicagoland's certified financial planning professional, president and founder of TJ Stearns, Inc. Tim, you make it part of your mission there at TJ Stearns to help people control, to understand, and to reduce their retirement tax bill.
That's right, Peter. Basically, everyone out there knows that when you're putting money in a 401k and your IRAs, you're taking a tax deduction now to pay the tax man down the road. And the misinformation basically that we've been given our whole lives is, don't worry, you'll be in a lesser tax bracket. But as we all know, the current tax bill is going to retire at the end of 2025. So we're looking at taxes going up from there. So I think right now and next year in 2025 are a great opportunity to take a look at what your tax bill is and what you can do to change that.
Well, Tim Stearns has a fantastic online calculator that can help you get a better understanding of what your retirement tax bill will likely be and some strategies that maybe can help you control that and bring that down significantly. If you would like to take a look at that, give Tim Stearns, CFP, and TJ Stearns a call at 800-640-2256. That's 800-640-2256, or go online. The website with the calculator available to you online is mvpcfp.com. mvpcfp.com is the website to go to for your retirement tax bill calculator. And I encourage everybody to go and view that, because Tim, when you enter in your numbers, you enter in your age, the approximate balance of your IRAs, the tax bracket that you fall in, the numbers are pretty staggering. I mean, for like a 60 to 65-year-old, sometimes the amount that they will pay in taxes over their projected lifetime is almost is pretty close to the balance of the IRA currently.
Exactly. I don't think everyone knows that they have a tax bill, but no one knows what it's going to be. And I want you to think about something. Who goes into the buy a car and doesn't want to know what the bill is going to be? Who's going to eat at a restaurant and doesn't want to know what the bill is going to be? I can go on and on, but your largest asset that we think we have besides our house is our 401ks and our IRAs. So wouldn't you want to know how much of that is truly yours? Because we don't. And so this exercise takes us through that, through our model that can show you how much you're going to be paying and require minimum distributions, also what you'll be paying if you reinvest the money. And then lastly, what your heirs are going to be paying, which comes into play with the Secure Act, part 2 that they did a couple of years back, that most everyone has to drain their accounts within 10 years of the person passing that's leaving them the money. So that turns on the tax bill real fast, because the stretch IRAs and the ways we used to do things are gone, and we need to pay that tax man sooner than later. So wouldn't you want to know what that is?
Tim, you made the comment there that when we invest in the 401k, that everyone knows and understands that tax bill is waiting for us in retirement. Do you find that a lot of people are actually surprised by how much they're going to pay in retirement, or maybe have even forgotten the back half of that arrangement at all and are surprised that there are taxes on those withdrawals?
I think a lot of people have misinformation out there who think, well, no, it's in an IRA, Tim, or it's in something else. Well, either way, if it's an IRA, a 401k, a 403b, 457, which is deferred comp in a lot of cases, those are all places that do one thing. They defer taxes. You will have to pay taxes at some point. So a lot of people are, unpleasantly surprised when we say to them, hey, you know how you think you have $1 million? You don't. The IRS owns some of that. And then when you reinvest it, they're going to own it, some more of it. And then if God forbid something happens to you, your heirs will have to drain that account within 10 years. And all that goes to taxes, to your tax bill at the end of the day.
Well, I think that there's probably a laundry list of things that people would probably do or have to think about than taxes, taking the trash out every day, getting stuck in traffic for 5 hours, having the in-laws come in and live with us. But here's the truth. Nobody likes taxes. yet nobody really takes the time to be as proactive as they should on the issue of taxes, Tim. And it's something that we are going to have to do sooner or later. It is a compulsory purchase. So why not do it when we've got the ability to have some level of control and final say over how and how much we are going to pay?
Peter, I love when you put it best when you say you're defaulting to the IRS's plan by just assuming that you're going to have to pay taxes at certain levels.
Which can
Why?
change.
Absolutely. And right now, they're the lowest they've been since 1926. The income taxes that we're paying today are the same that people were paying in 1926. So why wouldn't we at least explore what that tax bill looks like today? Maybe you don't want to do a Roth conversion. Maybe you don't want to even do anything about it, but at least you go into your retirement with your eyes open instead of closed and hoping for the best. I think a lot of people, one of the analogies that we'll show people is say, hey, you took the tax deduction on the seed, but when it grew into a crop, you have to pay all the taxes on that.
Yep.
And that really is kind of an eye opener for people. And it's just, it's the truth. So why not try to mitigate it and get ahead of it if you can and want to?
I actually was instructing an introductory course on financial education to a fraternity house that is trying to make sure that all of the members are on track. And I gave that exact analogy, Tim, of the seed and the harvest. And I asked them which one seemed like a better, more advantageous deal. And those young fellas, they all got it and said that pay tax on the seed now and keep 100% of the harvest tax free. And that's the deal with the Roth. But this generation that is currently reaching the peak of the conversion to retirement, the baby boomer generation for the past 35, 40 years, Tim, we've been taught, we've been told, we've been trained to do the opposite, to defer and delay and then wait around to be taxed on the harvest. Well, maybe now is a good time as any to look at how to manage the tax on that harvest.
Our CPA on staff will tell you, most CPAs are historians. They look back at the past and tell you what you owe in taxes. But, our CPA also is proactive, and we can run this report and show people how you might be able to mitigate some of those taxes and kind of spend them down. Pay your fair share, but not have to pay more than you should over your lifetime. And that report really knocks it home to people, that shows them this is what you're going to pay. This is what you're going to pay again if you're reinvested. And this is what your heirs are going to pay, your beneficiaries. So why not try to, mitigate some of those taxes? I think it's just absolutely a huge opportunity that should not be lost in 2024 and 2025.
Could your tax bill in retirement be too big? It can take you 30 seconds to find out, or at least get more informed on how much you could be paying in taxes throughout your retirement. The website to go to with the quick calculator is mvpcfp.com. mvpcfp.com. You put your age in, you put your approximate retirement balance in, your tax bracket, you run the numbers and the scenarios, and there's some more advanced software that Tim Stern CFP does have access to, but very quickly online, you can run those calculators and you can receive a report on if you defer and default to the IRS's plan for your retirement, how much they will get to collect. And there are strategies, ladies and gentlemen, to take advantage of, to be aware of, to control that bill, to reduce it and minimize it. And now is the time to take a look. So if you'd like to get a handle on that, get a jump on planning for and controlling that tax bill, go to mvpcfp.com. That is the website with the calculator that Tim Stearns CFP has made available to you just for listening to the program and to make sure that you have a better handle and understanding on the tax bill on your retirement accounts. mvpcfp.com, mvpcfp.com. During our working career, Tim, we sort of understand that when we earn wages, that's taxable income. And actually the IRS generally takes their share of that money before we even see it, which nobody loves, but I think it makes it a little bit more palatable that we see our money after Uncle Sam has already taken his share. In retirement, it's very different. Withdrawals from IRAs and 401ks are going to be taxable income, just like those wages that we earn during our working career. Every dollar will be taxable, but we are responsible for making sure that the IRS gets paid their just and due share each and every year. And that's a little bit more painful. I think it's a bit of a wake up and realization when people actually have to pay that bill.
Well, I dare say some people don't understand that concept, because I've had people say, hey, take out when they first retire, hey, take out X amount. I'll say, well, what do you want to withhold from taxes? Well, I don't want to pay taxes on it. And, you have to kind of give them a refresher that, you've deferred your whole career, and now is the IRS wants their pound of flesh, and it's coming out whether you like it or not. So what is that amount? No one wants to owe the IRS money. So, I mean, these are things that people, that's another reason that we teach our retirement classes, is to get people on the same page as what reality of this modern retirement looks like. Many of them don't know what the Secure Act did as far as to Roths too. If something happens to you, the Roths have to be spent down within 10 years. There's a lot of different things that have occurred that I don't think people have really kept up with. Even the more educated people that come to our classes aren't aware of different things like that. They'll say, no, the Secure Act only affected IRAs and 401ks. And no, they infected the Roths too, and so all that good stuff has to be spent down within 10 years.
And again, if you would like to see what your bill would be if you defer to the IRS's plan, that is at the website mvpcfp.com, mvpcfp.com. You go there, you enter in just a little bit of information about yourself, your age, your approximate balance, the tax rate that you see yourself in retirement, and boom, you've got the calculation for what that tax bill will be over your life expectancy if you default and defer to the IRS's plan for your retirement. And yes, they do have a plan. Tim, as you mentioned, that income coming out is taxable, but we still don't know at what tax rate unless we are proactive today. Because those tax laws change what they deem as their share of that account. They get to control and adjust if we continue to defer and default. So these calculators that you have online, they take into account tax laws as they stand today and can be adjusted for what we think they may be in the future. But I think a lot of people believe that taxes could be going up.
I don't think I've yet to have someone in a class say that they think taxes are going down. Not a soul. And the bare minimum, they're going to revert back to what they were before the Trump tax bill. So I mean, the 12%, for example, goes to 15%, just to give you an idea. And like you've talked about, a 3% hike doesn't sound that bad, but it's 25%, right, increase in that tax bracket. So wouldn't you like to know what your taxes are now, because it's only going to get worse in the future? So, I mean, let's not bury our head in the sand and kind of figure out, could your tax bill in retirement be too big? Why not fix it?
Tim, I'm running the numbers, and we've seen a lot of scenarios that are just eye-opening, shocking, where people can save on taxes by more than 50%, more than 66%. And we ran a scenario to talk about here on the radio for a 60-year-old with $1 million in their 401ks or IRAs or their tax deferred accounts at a 20% tax rate, deferring to the IRS's plan for required minimum distributions, being taxed on reinvestment of those dollars, and then what will eventually be left in a legacy. On $1 million balance today, the IRS will likely collect more than $869,000 in taxes if we do nothing but defer to their plan. However, with where taxes are today, we could control that, reduce it, minimize it. We may be able to get that down to as little as $200,000 in taxes. Now, that's a dramatic savings.
I mean, Peter, that begs the question that, doesn't it make sense to at least assess that, when 80% of your money is going to the government? I would want to know exactly what my bill is, and that we can accentuate it here and make sure that we know exactly what it can be. And that's under the current tax bill. I'd hate to see what it will be down the road.
Now, Tim, granted, this is projecting out over the course of a lifetime. right? Is that this tax bill is not due all at once when we look at deferring to the IRS's plan. It would be due over the course of life expectancy, and you can play with those numbers with these tools and calculators as well. It's a really great tool for fiddling with different variables and figuring things out. But Tim, to look at $1 million balance and see that should we defer to the current IRS plan, we would end up owing and paying more than $869,000 in taxes over our lifetime. That's just mind-boggling to me that we would owe that much based on that current balance.
Right. It just shows you how much is really yours. And that's another thing that I tell people, if you're still working out there, the 401k, 403b Roths are a great place to stick some money. Pay the taxes now because, again, income tax has never been lower since 1926. We haven't seen these rates. So that's a great way to start it. Even if you're 60 years old, if you're going to work another 7 years, why not defer, take the tax hit now and let that thing defer and grow tax-free for 7 more years at least. These are great opportunities that are out there. But then, of course, we come back to the Roth conversion, argument. Do I do it now? Do I not do it? I'm not telling anyone to go out there and to do $1 million Roth conversion, but I am telling people, why not look at this calculator and see where you're at? It begs the question, where are you at? Wouldn't you want to know what you owe in retirement so you can see what's truly yours?
Well, again, if you would like to look at being proactive and controlling your retirement tax bill, you can do so with the help of a certified financial planning professional, Tim Stearns, CFP. As we all have taxes on our mind this time of year, it's a great time to be proactive and look at the years ahead. So you can do things now to control and minimize that tax bill for those years ahead. And that's what Tim Stearns strives to do with each and every one of his clients there at TJ Stearns Inc. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256, or go online to the online calculator. The retirement tax bill calculator can be found at MVPCFP.com. That's MVP like most valuable player, CFP like certified financial planner. Tim Stearns is a certified financial planning professional. So MVPCFP.com to run the retirement tax bill calculator provided to you by Tim Stearns CFP, or give a call if you would like to talk over strategies. Make sure that you are crossing the T's, dotting the I's, doing it correctly, but managing, controlling, and minimizing that tax bill where possible while tax rates are historically low. And taxes feel like a pain, but they are right now historically low, and it's a great time to look at being proactive. Give Tim Stearns CFP a call, 800-640-2256. That's 800-640-2256. And Tim, by the way, these numbers in this report, in the scenario that we've generated for discussion here on the radio, that is if tax laws and rates stay the same. In 2022, we brought in $4.9 trillion of revenue, and before Congress whispered about spending an additional dollar, 4.6 was already spent in non-discretionary mandatory spending. And then, of course, Congress did spend even more, and we ended up another $1.3 trillion in debt for fiscal year 2022, adding on and bringing us to a current total of more than $34 trillion in debt. Do we think that taxes could go up into the future, Tim?
The only way that they can pay off these bills is either A, they balance a budget for once, which I don't see that happening.
Hasn't been done since 2021.
Exactly. Or secondly,
I'm sorry, 2001. 2001.
Right. I was going to say, yeah, it's been a bit. So that, or they're going to, have to raise taxes to pay these bills, and they're happy to spend our money. That's for sure. So when they spend our money, they just, if it's arriving at a deficit, they're going to be taxing more. And, I tell you again, so many people in my classes are raising their hands when I say, do you think taxes are going up? They give me the thumbs up, and they're not happy about it, but that's how it's going to go. So why would I not try to take advantage of the last 2 years here of the Trump tax bill to get some savings?
We do have that opportunity as well, Tim, because for this year, for last year, for 2024 and 2025, we've got the higher standard deductions in place. The tax brackets have all been elevated. That means more of your money falls into lower brackets. So it does give us more wiggle room to manage and control the taxes on those retirement accounts.
Right. So, I mean, wouldn't you want to control the narrative? So that, and that's one of the reasons that we are having this conversation. I mean, what do you do every April 15th of every year? You shoulda, coulda, would have yourself, right? You Monday morning quarterback and say, man, I paid way too much in taxes. How do I get ahead of this? Well, unfortunately, by April 15th, you're a quarter into the year, correct? So these are things that, I'm trying to wake people up here and say, hey, you have a huge tax bill out there. Let yourself run these numbers, see where you're at, and see if you can start to bring that thing down. Why wouldn't you?
Again, if you would like to take a look at being a little bit more proactive in managing your lifetime tax bill on those retirement accounts, first step, go to mvpcfp.com, run the calculator on your situation, your balance, your age, your projections will be generated right there for you to take a look at. And then with the help and assistance of an experienced, qualified professional, takes the steps to start managing that tax bill. And you probably don't want to do it all at once, but it is time essence. There is a pending tax increase on the future. And Tim, in 2026, when the tax rates do increase, if nothing else is done, we are slated that the 12% bracket goes to 15%. That is not a 3% tax increase on those first few dollars that we earn. That is a 25% higher tax bill on those dollars. And the brackets keep going up.
Right. And you're going to go back to how it used to be before this current Trump tax bill. They can't decide whether tomorrow is going to be Sunday, right? So, I mean, I can't see them getting together to really push through a new tax bill that will be in our benefits, right? Because we're spending money more than they ever have. So why not look at that? The other thing, Peter, that we've talked about once or twice in the last couple of months is, the federal estate tax in 2025 is going to sunset too, and it's going to come back down to $5 million. And many of these people in Congress who love spending our money have talked about moving that down as well to capture more estate tax dollars. So that begs the question: how much do you owe in estate taxes too? Once they change these rules. So these are all things that we're seeing that an increase in taxation, a lowering of the federal estate tax minimum that they're going to be doing at 2025. I mean, that's when it sunsets. I see us paying a lot more in taxes. So I would want to get ahead of that and figure out, do I need a trust? Do I need this? Do I need that? Should I be doing Roth conversions? Should I be doing a Roth at my job? These are all things that we can help people with. If you're out there wondering what your tax bill is, hop on this website, figure out what your tax bill looks like, and see if we can help you with it.
And we are very short-sighted, unfortunately, Tim, with our financial decisions often. And a lot of people with significant savings may be looking at the current tax environment and the current estate tax levels, where a married couple can pass 27 million between the combined couple and not experience that federal estate tax. And they say, well, I'm not there, that's not going to affect me. But if you've got a $3, $5, $6 million kind of retirement nest egg, including, by the way, properties, right? That goes into it, your residence value, all the property values that you have, and then compound that. Let's say that things do continue to grow for the next 10, 15, 20 years. And in addition, they do change some of those laws and bring that estate tax level down to 5 million or less, right? A lot of people, in essence, what I'm saying, Tim, in summary, a lot of people who may not actually truly be impacted by estate taxes if they were to pass away today, many, many more of them likely will encounter estate taxes if they don't do some proactive planning now.
Exactly. And that's what we're here to help people with. We have a CPA on staff. And if you're out there wondering, what is my federal estate tax? What is my income tax bill if I don't do any conversions and that type of thing? We're here to help. Go to the website, put your information in there, and we'll get it done.
And by the way, Tim, I'm glad you mentioned that, because what we're talking about is not necessarily the estate taxes and the tool, the online retirement tax bill calculator that you have available there at nbpcfp.com. That is not including estate taxes, that is income tax, and income tax is going to be due before estate taxes are even encountered or an issue. A lot of people have forgotten about the income tax and don't think that the estate tax might apply. And man, we might be in for a rude awakening and double whammy when both of them end up applying.
Right. And that's why you should, at least at the bare minimum, come on this website, figure out exactly what your IRAs and your 401ks are going to be thrown off as far as what the taxes are.
Again, mvpcfp.com is the website. mvpcfp.com. Go there, get that retirement tax bill calculator. Could your retirement tax bill be too big? Well, you do have the opportunity to be proactive and control it. Even though the IRS has a plan for your dollars, you can plan proactively as well. And we encourage proactive planners and savers to jump on that website, nvpcfp.com, run the numbers, take a look at the likely future tax bill, and then get a better understanding of the strategies that you have available to control it, to reduce it and minimize it and eliminate unnecessary taxes from your financial and retirement and legacy future. You can also give a call. It's part of the Protect and Grow planning process, by the way. The Protect and Grow plan is the written plan that Tim Stearns, CFP, and his team there at TJ Stearns Inc. will put in your hands for being a listener to the program. If you would like to get that Protect and Grow written plan, just give a call, 800-640-2256. That's 800-640-2256. But once again, the online retirement tax bill calculator, you find that at mvpcfp.com, mvpcfp.com. When it comes to taxes, Tim, like a kind of another story and analogy, I could walk into a department store and I see two racks with identical items on each rack. And it's something really nice. Maybe it's a new leather jacket that is just a beautiful leather jacket that I've been thinking about getting. And I take a look at both racks and I say, it's the same exact item. This one over here has a for sale sign on it. It's sale. It's marked down 25% off, right? And I pick it up and I look at it. I'm not going to buy the one that's on the full price rack. It's the same item. It's listed for sale. I would buy that one. But I may look at it, Tim, and say, yeah, it's beautiful. It's a nice jacket. I still don't want to pay even the sale price and put it back. Well, taxes are a compulsory purchase. We have to pay them sooner or later. So wouldn't it make sense to buy it, to pay it while it's on the sale rack?
Exactly. And that's what you have for 2024 and 2025. I think you at least go through the exercise so you can see exactly what you're facing in retirement.
Well, again, tax season is upon us. And I know this is not the time of year that we necessarily look forward to, but it is a time of year that we all have to deal with. We all have to make sure that we do what the IRS requires of us, right? And pay our fair share. However, Tim, it is no person's moral, ethical, legal duty to pay more than that fair share. And where we've got these opportunities, we should take advantage of them. So again, ladies and gentlemen, if you would like to see that retirement tax bill calculator, it is available to you online. Just go to mvpcfp.com, mvpcfp.com for the retirement tax bill calculator, or give Tim Stearns, CFP, a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Now, Tim, we've been talking a lot about being proactive and looking forward, but there are actually still some opportunities for a couple moves that we could do for last year. You can make your IRA contributions all the way up until that tax filing deadline.
You have up until April 15th to do this. You can do for last year, or even this year, if you want to get ahead of it, for your Roths and your IRAs. So those are definitely things that can help you mitigate some of the taxes, but why not take a look at the exercise of what is your full 401k worth to you actually after you take into effect taxes? This exercise spells it out to you really simple. So I would tell anyone who's out there wondering, how much do I really have for my retirement? Go through this.
Well, again, ladies and gentlemen, the calculator is available to you online. Go now, mvpcfp.com, mvpcfp.com. It'll spit out a report, some numbers for you. Really take a look at what could you potentially owe to the government, to the IRS, over the course of your retirement on those hard-earned, tax-deferred retirement account dollars. pick up the phone if you'd like to get a handle on the strategies to control that, to reduce or minimize that bill. The website again, mvpcfp.com, mvpcfp.com. Your opportunity to get a handle on controlling that tax bill by calling Tim Stern CFP at 800-640-2256. That's 800-640-2256. Tim, a fast moving segment of the show. We always appreciate your time. All out of time for this program today, but we want people to save money where they can, to reduce and minimize that tax bill, and that is why you've made that website calculator available at nvpcfp.com.
Yes, Peter, I urge everyone out there, give it a shot and take a look at what your bill looks like.
Tune into Chicagoland certified financial planner Tim Stern's full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.